Welcome back. More guidance for turbulent times and low interest rate environments. This week, navigating CDs and savings accounts. Hello everybody, I'm Telton Hall at Advanced Financial Planning in Cedar City, Utah, where our team helps upper middle class and affluent families accomplish their retirement goals. Prolonged low interest rates are a game changer. So this is our 6th video in a series designed to help you address the most common questions, concerns, and misconceptions around retiring into a low interest rate environment. So far, we've taught a lot about the Fed funds rate, which is set by the Federal Open Market Committee, and we've taught particularly about the 10-year Treasury note, specifically the yield on the 10-year Treasuries. It's been important because of its correlation with long-term mortgage rates. We covered that in video 4. Now we've got the foundation in place. Let's jump into CDs and savings rates. They are affected by a combination of Treasury rates, Fed fund rates, and the supply and demand of consumers. I think of it in these pretty straightforward, simplified terms. Remember that the Fed funds rates are the daily rate that determines what banks charge each other overnight. That's an ultra short-term rate. Very similar to how a savings account is liquid every day with no early withdrawal penalty. For instance, in March of 2020, the Fed funds, which is ultra liquid, very short-term rate, was set at 0.00 to 0.25. So then you can expect that savings accounts, which are also ultra liquid, very short-term rates, they're going to be in line with that. According to the FDIC, the average rate on a savings account right now is 0.06. So it's kind of right in the middle of 0.06. From 0 to 0.25, you're inside of those parameters because they're both so ultra short-term rates. They're very closely aligned. And neither of them can go really any lower without getting into negative interest rate territory. Keep in mind, one strategy here is that a high yield savings account might pay 1 or even 1.5% higher than traditional savings accounts. They typically accomplish this little bit higher rate by a combination of being an online bank and not a brick and mortar, or having a higher balance minimum, which in effect kind of limits the liquidity. They might limit transactions, and typically they don't provide a debit card. All of these strategies are ways to limit daily liquidity in order to pay a higher rate. Remember, you can always cash out with any given moment of any given day. Obviously, you won't keep getting that higher interest if you've depleted the account, but for your emergency fund, where you want it to be a decent chunk of funds, you want it accessible, you don't want it to be fluctuating, and preferably we'd like it to be FDIC or credit union insured. This could be a really good option. You would need to be comfortable doing electronic transfers to the bank where you have your checking account. So you can take advantage of a little higher rate over here, and if you're really in a financial pickle, then you electronically transfer funds over to your checking account, so then you can spend it on your needs. So to finish that up, savings accounts are going to be highly affected by the low Fed funds rate. Now for CDs. I have lots to say about CDs. CDs are interesting in that they are influenced both by the Fed funds rate and the 10-year Treasury yield depending on their term, how long the term of the CD is. Take a look at this chart. It shows the Fed funds rate in blue and the 6-month CD rate in red. They are highly correlated. But if a CD gets longer in duration, it becomes less correlated to the Fed funds rate. So in chart number 2 here, you can see the Fed funds rate, it's in gray, and the average 1-year CD. So before we looked at a 6-month CD, now we're looking at just a 1-year CD rate, it's in the dark blue. It's still correlated. Notice how much more disparity there is in these two lines compared to the chart before, where the 6-month CDs and the Fed were nearly overlapping. The longer a rate is for, it's likely going to deviate that much farther from the very short-term Fed funds rate. We are already in a low interest rate environment, so we'll talk in depth about how to deal with that. But as a future planning strategy, one thing to be aware of, notice on this second chart how in 2005 CD rates actually started to rise first as banks tried to attract more deposits in order to be able to make more loans. But once the Fed started raising rates, the banks couldn't keep up with that high of rates on CDs and still be profitable. And they didn't have to, because at that point depositors felt like, geez, 3% on FDIC accounts, we all felt like that was pretty good, meaning banks had plenty of deposits to meet their loan requirements, so then bank CD rates started to lag the Fed. Compare that to 2016. Instead of the banks leading the way with rate increases, it was the Federal Open Market Committee who began increasing rates, and the bank CDs, on average, didn't really respond that quickly, which makes sense. If the banks have sufficient deposits to cover the requirements to make the loans that they wanted to, and those deposits, they were locked in for 1 or even 5 years at really low interest rates, meaning that's a low cost to the bank, why would the bank be in a hurry to raise their rates, pay more for a new depositor that's going to be in a 1 or a 5-year CD locked in and cost them more money? So one little tidbit here, high yield savings, on the other hand, they're not locked in for a term, so they are affected much more by short-term rates. So you actually had the upper echelon of high yield savings accounts, they were paying 1.2 to even 2.2%, while in that same time frame, 1-year CD rates where you were locked in were averaging 0.5%. That's just fascinating. Fascinating times for nerds like me. So be aware of this, and at some point, probably a ways down the road, if you're trying to maximize your yield on FDIC accounts, 1 or 2-year CDs, I would guess, are probably not going to be the place where you want to be. Now let's tackle 5-year CDs. You can still get 1 to 1.5% if you elect to do a 5-year CD. Because banks now need to outpace not the short-term Fed funds rate, they're trying to compete with the 10-year Treasury yields to make their CDs attractive. I look at 5-year CDs in 2 ways. First, if you have a 5-year CD and you need to use the money before 5 years, then you'll typically pay a penalty that equates to, usually, they vary, but usually it's 12 months of interest. This is not the end of the world. The reason you have it in the CD is for liquidity, accessibility, FDIC insurance. If you're never going to touch that money, then you could probably put it in like a growth allocation and forget about it, not a CD. If you're not going to touch it for 5 years for sure, you could use a 5-year fixed annuity and get 3 or 4%. But if we're talking CDs, we're talking emergency fund money. We want it stable, we want it liquid, we want it accessible. Let me give you an example. If you're getting 1% on $40,000, you would earn $400 a year. So after 1 year, you could take out the CD and you would break even, interest offsetting the penalty. At the end of year 2, you could take it out and still keep $400. So 400 on 40,000 is still 0.5% per year. Not great, better than in a savings account at 0.06%, which is the current average. So don't get caught up on the CD early withdrawal penalty. I'm telling you, people will pay taxes and penalties on IRA withdrawals, or they'll pay interest on credit cards or appliance loans. They give up their right arm and they will die on the sword to avoid paying an early withdrawal payment on their emergency fund CD. Don't get caught in that trap. That's number one thing I want you to learn about this. 5-year CDs are great for emergency funds. Just don't forget that it's your emergency fund. It's not your mom's or your grandma's CD. No disrespect to your mom or your grandma. We love them. But times have changed, and a 5-year CD, it's certainly not an accumulation vehicle in this low interest rate environment. So don't treat it like it is. Thanks for sticking with me through that. I think you've now officially experienced a Telton rant, albeit a very short one. Sometimes my older daughter will ask, "Dad, this is really interesting. Should I grab a chair and have a seat and get comfortable? We gonna be here a while?" It's a very good tactic on her part. Either it laughs or I say yes, and then she knows she's in for the long haul. Okay, second thing I want you to learn. If we're looking at 5-year CDs, we likely need to get more clarity on the objective and time frame around those funds. Let's say that you're heading into retirement, and to be smart and conservative, you have saved $100,000 in savings. You say Telton or Caden or Marty or whoever here at AFP you're visiting with, this is enough money that I actually want to try to get some yield from it. But I still want to keep it liquid and accessible. Our planning would be how much of this is true blue emergency fund, meaning we need to keep it FDIC insured. We don't want any fluctuations on it, and we need it boom ultra accessible. And how much of this is more like kind of reserve money, where we're probably not going to need it for several years. We want it accessible if we need it, but we'll likely know a few months or even years before if we're going to make a big expenditure or take a huge trip. So based on that, let's pretend that you decide $40,000 is your true blue emergency fund money. And we use a high yield savings linked to your checking for quick accessibility to fulfill that piece. Then we can explore other options that pay a higher yield. They're still totally liquid, totally accessible, and they're conservative, even if they fluctuate in value from day to day. There are some really good options for that if we can get clarity around what is the objective of these funds. We'll cover those other good options in the next video. You can see there's a lot to navigate in this low interest rate environment. Stay with us, you're gonna be a genius. Or better yet, let us do all the work and make sure you're on the right track. Whether you're wanting to retire, you're retired and still have retirement accounts sitting there, or you need to update your current investment plan for this new interest rate world, we'd love to help you make the most of it. Give us a call for a second opinion. We'll talk to you soon.
If this information has been helpful to you, check out our other Telton's Tips videos, or better yet, call our office. You can talk to an advanced financial planning team member like me. Imagine that, a real life human that cares about you and your goals. My name is Caden Keller. I work here as a financial advisor along with Telton and the rest of the team. Here, we take a team approach to caring for our clients because we all know 2 heads are better than 1. So give our office a call, and I or anyone else on the team would be happy to answer a quick question for you or schedule a complimentary retirement planning meeting. There's also a link provided if you would like to learn more about who we are at Advanced Financial Planning or what it is we do for our clients in planning for their retirement. Lastly, the schedule an appointment link will bring up our calendar, and you can choose a time for a complimentary on the phone or an in-person retirement planning meeting. Whichever option you choose, the only mistake is to do nothing and keep working and putting retirement preparation off until you die at your desk. I've seen it time and time again. No matter how good and specialized Telton and I are, when people wait too long to seriously consider their retirement options, they're significantly set back and can damage their retirement. So call, schedule, or click to learn more. You've got nothing to lose, and your future self in retirement has a whole lot to gain.